Hey everybody, we're going to get started here with our next presenter. I've got Nick Blitterswyk here with UGE, and I'm going to hand the mic off to him and he can begin his presentation.
Great, thank you very much. And thanks everyone for taking some time to learn about UGE today. I'll try to get started right away so that I'm not rushing like the last guy. All right, so just off the top, so number one, in terms of why you're right to spend a little bit of time here with me this morning. So UGE, number one is that we're growing very quickly. So of course we'll go through that here in a little bit, but we're a very fast-growing IPP, so an owner-operator of renewable energy projects. Number two is I've been doing this, and we've been doing this for a long time. So I started the company about 14 years ago. We have a tremendous amount of experience in this space. That's right now over 700 projects, 500 megawatts of experience, working with groups like T-Mobile and Bloomberg and many other big names over the years that have trusted us to develop renewable energy projects for them. And then lastly is there's very much a feeling of being in the right place at the right time. So all the experience we've had to date, the growth in the industry, and then the Inflation Reduction Act being the most recent tailwind that's providing a really significant boost to the prospects for our industry. So I use the term IPP, and even for UGE, this is a term that I've started to use more recently. Traditionally, as a company, we're a developer that goes out, develops, brings these projects to life. But a couple of years ago, we pivoted to being a developer, owner, operator of projects, something I'll talk about more as we go through the deck. But just in terms of an IPP, how they're valued and what the appeal is here. So number one, it stands for independent power producer. So a company that owns and operates energy projects. They don't have to be a renewable energy. Brookfield Renewable Energy Partners is like one well-known name that's a renewable IPP. In terms of the appeal, so it's at the end of the day, it's like utility grade recurring revenue long period of time, right? So you're owning and operating these projects that you're generating revenue from the energy that they generate over a long period of time. Because of that utility type of recurring revenue, they're valued pretty high. So the current comp set has a EV to EBITDA multiple of about 13 times. I saw a similar comp set recently that was even higher, but for the sake of this presentation today, that's the number that we're going to use. In terms of UGE versus other IPPs and how we compare and how we stand out, number one is that we are first and foremost a developer. So we control our pipeline, our development funnel. We'll share a lot of information on that later about how fast that's growing and how much value there is in there. But the typical IPP is often acquiring projects from other sources, whether that be developers or other owners and operators of projects. So having our own development funnel means that our returns are higher from an IRR perspective, from a cash flow perspective. Number two is that we focus on mid-scale projects. So these mid-scale projects are the fastest growing subset of the U.S. solar industry right now. They have higher returns. They also get through interconnection more quickly than the utility scale projects do. And it also allows for our quote-unquote equity-light business model, which we'll come back to later. But in essence, what this is leading to is the highly profitable cash flow aspect to our company, which is really starting to take shape here in 2023. And then lastly, because we are the developer of these projects, we're the ones that are turning them on, but we have 25 to 40 years typically of recurring revenue sitting out in front of us for these projects as we turn them on. Versus other developers, the way that we stand out is the traditional way that developers in our space worked is they would develop projects, flip them to funds who would buy those projects. We set it upon ourselves several years back to build out this full life cycle model where we would own and control the development of these projects from the beginning until they were up and owning and operating those projects and generating revenue over the long term. We're like a really firm believer that in the mid-scale space, this is the way to capture the best returns, the best market share. And the reason being is, number one, efficiency. With these smaller projects, if you're buying and selling them and so on, there's margin stacking, there's inefficiencies, et cetera, which is really apparent to the repeat customers that we work with. So if you think about a large real estate owner, if we can just be the one name they're working with throughout the entire process, then we're providing them a much better experience as well. So as you look at our business and you look at the development pipeline that we have, what I think you can't help but come away with is that we have a really significant value creation engine that we're generating here. So what we do is we go out and so we find places where we're going to develop these projects. It takes about 2 to 3 years to complete that development life cycle, with the interconnection approvals and so on being the longest part of that. But in total, we're spending in that part of the project life cycle about 3 to 10 cents per watt. Once we get the project to NTP, or notice to proceed, which is the beginning of the construction phase of the project, that's about how much we've invested in a typical project. Now, NTP, I got to say, is a really important term within our industry, because if you're a developer and you get a project to NTP, that's where the project is considered de-risked. That's when the developer has reached their ultimate value for that project, in essence. The construction of these projects is considered completely vanilla. That's a fairly low margin business. It's more of a means to an end for creating these assets. So NTP is important, and keep that in mind as we're seeing our portfolio mature here over time. I will touch on how we finance these projects in a little bit, but in essence, once those projects are operational, we're targeting about 18 cents per watt per year in project level EBITDA, and net of debt, we're looking at about 10 cents per watt per year. So if you take that, multiply by that 13 times that we looked at on an earlier slide in terms of the current comp set, you get about $1.30 per watt of value that we're generating from each watt that we successfully develop from origination out to being in our operating portfolio. As of March 31st, we had 313 megawatts of backlog. So if you just do the simple math there, we're talking about 400 plus million of value in our backlog as of right now. Good time to mention our market cap is just north of 30 million US right now, but we'll come back to that a bit later. So the types of projects that we do, generally speaking, we're talking about mid-scale projects, like I mentioned. The interconnection, as people who follow the industry know, is the kind of high pole in the tent. It's where our outdated grid is congested. These mid-scale projects can move through those interconnection queues more quickly. The three types of projects that we're mostly developing right now fall into these three categories. The first one, community solar, that's an industry term. What it means is we have one project, and then we divvy up the energy that's generated to a number of off-takers. Right now, just under half of the states in the country have community solar legislation in place. That was 4 states just a few years ago, so it's growing very quickly. Specifically, community solar is the fastest growing part of the U.S. solar industry. Number 2 is more generally power purchase agreements. So what we would have here is one project, one off-taker of that energy. This could be, let's say that it's a project on top of a mall, or a ground mount project that's feeding a town, things like that, where we have one project, one off-taker. That's about 10% of our projects right now. And then lastly is battery energy storage. This part of the renewable energy industry really passed the hockey stick part of the growth curve about 2 years ago. It's growing really quickly. In 2022, there was more battery storage built in the U.S. than natural gas. And if you look at interconnection queues, we're never looking back. This right now is about 30% of our backlog. And when I say battery storage, I should say I'm talking about standalone battery storage systems. Probably could spend half an hour talking about how that works, but we're excited about the growth in that space here. 3 quick pictures to show some recent projects of ours. The one on the far side there is a liquor distribution warehouse just north of New York City. That one is a community solar project that we turned on in October. The ground mount project here is in Texas. We turned that on in January. That serves a town which is on the outskirts of Austin. And then the bottom right here, I should actually update that picture because the panels are all up now. That is a community solar project in Maine that we're looking to complete in about a month from now. That is on a capped landfill, which I'll talk a little bit about the investment tax credit later, but qualifies for additional tax credit based on being on that repurposed land. This is our overall development pipeline. We report this in our MD&A and a file that we call our supplemental disclosure each quarter. A lot of data on this slide. I'll just draw attention to a few things. So number one, I think I mentioned that up until a couple of years ago, we used to develop and sell our projects to other owners, and we pivoted the business. So the operating part of our portfolio is just starting to scale. So far this year, it's already grown about 50%. Over the course of 2023, we're going to see that grow about 10x, and we have a goal to get to 100 megawatts operating in a little under 2 years. Number two is that our overall development pipeline there of about 800 megawatts, that's going to be a gigawatt here pretty soon. A gigawatt would be, call it $2 to $3 billion in project value. Those are contracts we have to develop projects. So we have the land secured. We're working through the earlier stages of development, with the project backlog being a subset of that. So these are projects that have completed the initial steps of development. We have, of course, the contract. We passed our investment committee process that says, okay, we believe that this is a project that's going to happen, and we're focused on moving that to commercial operation as well. Just a couple weeks ago, we put our Q1s, and so a few milestones that relate to how fast the portfolio is growing and maturing here. The project, or the graph on the far side there. In Q1, we had a record amount of backlog growth to get it to 313 megawatts. That 313 megawatts is worth in the range of $900 million US in total project value. The assets in deployment. So, I mentioned that we pivoted the business a couple of years ago to be a builder, owner, operator. And so we're just starting to see the fruits of our labor there as the portfolio matures. So Q1, we had 10 megawatts hit the NTP milestone. We're looking to have a similar number of projects hit NTP in Q2 here as well. And then, as mentioned, our operating portfolio really just starting to scale, but we're expecting that our operating portfolio will grow about 10x here in 2023. And the map on the near side here is where our portfolio currently resides. We were traditionally more of a Northeast developer, but over time we've become more of a national developer of these types of projects. As these projects come online, they generate this long-term recurring revenue. This graph here speaks to that. So, 2021, we didn't really have any recurring revenue, right? We were just making that pivot. 2022 in percentage terms grew really significantly, but 2023 is where we're going to see those numbers become a lot more material. And then as we go to the 100 megawatt mark and beyond, those numbers will scale up quite significantly. We've been averaging over 90% gross margins on our recurring revenue. We've been targeting at least 85, but this is very, very high margin recurring revenue as these projects come online. So we have all these projects, and that's great, but how are we going to pay for them? So within the industry, the way that you finance projects is pretty well known. So the first half of this slide just speaks to that from a typical structure. So number one is you have non-recourse debt, which goes into the project or the portfolio level. This is non-recourse to the parent, and typically from banks and insurance companies, things like that. Next, you have the investment tax credit. So this has been available for close to 20 years now, but was really enhanced with the Inflation Reduction Act last August. So the way that developers or funds monetize the tax credit is through tax equity partnerships. So corporations and other folks who have tax liability will, in essence, purchase those tax credits from the project. And then lastly is, okay, so the equity from the developer or the owner of the project. So that's a typical capital stack in these projects. Now for UGE, we have banking relationships that we work with for the debt. So we've worked with several different banks. We have several different financings on the go right now for upcoming projects. And then on tax equity, we have several institutional partners we work with there to monetize the tax equity as well. I will say that in the wake of the Inflation Reduction Act, we are seeing average tax credits north of 40%. And as domestic supply chains come online, we're expecting that to climb probably north of 50% based on a domestic content adder that's available. And then lastly, because of our full life cycle model and because of the mid-scale projects and the high cash flows and high returns those projects have, our equity is actually paid in kind. So our projects, I mentioned equity light earlier, as these projects come to fruition, we actually extract what the industry refers to as a developer fee out of these projects. So if we go a layer deeper here in terms of our projects, so actually I kind of already mentioned this a little bit, but average investment tax credits of 30 to 50% or higher post IRA. I should mention too that these tax credits are both based on the fair market value of these projects. So the way that it works is you have an appraisal firm come in and say, okay, this is the fair market value for this project. The tax equity investor buys in at that rate, and that establishes the tax basis for these projects. So if you take a simple example, $2 per watt for CapEx on a project, $3 for a fair market value, and a 50% tax credit, you're talking about getting $1.50 of, in essence, free money towards the value of that project. When you're working with banks on the debt, that's really sized based on the debt service coverage ratio, like the recurring revenues that are going to be generated after the project's turned on. And then the net result is you bring in those sources, you have your CapEx, your uses of capital, and the net there is your developer fee that you're extracting from the project early on. Luckily, we have a recent example here. In March, we announced 3 projects in Maine. Together, those projects were 6.7 megawatts of rated capacity. We announced $19.6 million of debt plus tax equity financing. The debt in that case was at 5.79% from a regional bank in New England there. I should mention, like, that, as we go through the closings on these financings, I think there was close to 100 signatures that I personally had to put. There's a lot of due diligence and so on that gets to that point. But if you just do the simple math there, right, we're bringing in 19.6. We're spending about 13 on CapEx. Just from those 3 projects this year, we're extracting a development fee of about $6.5 million US, which is something like 70+% of our annual overhead. And that's only a minority of the projects we're building this year. So the net result is that this is 2023, the year that UGE turns cash flow positive, which is something we're really excited for. Also, not to mention that if you look at the megawatts we're building now, it's a very small slice of our overall portfolio, so we don't ever intend on looking back. So with that, just a couple things to cover. So we're traded on the TSX-V. We've done like the early preparations towards uplisting to the main board as the portfolio takes shape, so in the short to medium term future there. We have a pretty clean capital structure, a little under 33 million shares outstanding. There's virtually no warrants, less than 1 million. So most of the fully diluted relates to just employee options over the years. Current market cap, just over 40 million CAD or just over 30 million USD, and insiders own about 33%. So it's a pretty strong shareholder group there. There's 4 analysts that cover the story. I'm sure all of them would be happy to hear from yourselves if anyone has any questions or wants to get hold of their research. Average target price is in the range of 3 times the current share price. And then lastly, just on the team, so I started the company again about 14 years ago, and we've assembled a really great team and had a lot of great experience over the years. In recent last couple of years, we've had a number of great additional folks to the team. Trevor in the middle there, he joined us as our COO earlier this year. He had been the COO of a company called Blue Raven Solar. He joined when it was just a few million of revenue. They exited that about a year ago to SunPower for over 200, or when it had over 200 million in annual revenue. And then Andrew Hines was the co-founder of a group called CleanMax, which was the leading corporate developer of renewable energy projects in India and parts of Asia. His personal clients were groups like Apple and Facebook and Cisco and others. So we're excited to have both of them on the team here as well. And there you go. So with that, happy to take any questions and glad that I didn't need to rush through the last few slides. Yeah, that's right. It's kind of like a 1-2 punch. So you have a third-party valuator that comes in, and then the tax equity investor comes in and invests at that rate. And so there's like a safe harbor from the IRS that says like that is a legitimate way to value the tax credit for that purpose. Yeah, so there's a bunch in there. I think that maybe first, in terms of just how out of whack, I mean, there was a slide earlier, I had 100 megawatts. I could have had 313, but the graph would have been too extreme. So I think on that basis, we know there's a tremendous amount of value in here. Just on, you know, the valuations you talk about, the backlog, there's probably close to, you know, 400 plus million of tax credit alone in the backlog right now, right? So yeah, so we think there's a significant disconnect there. Also from a cash flow generation perspective, you know, one can do the math that I looked at there. You know, over the next couple of years, we're going to be generating more cash than our current market cap just over the next couple of years. So there is definitely a disconnect there. In terms of why, I think, you know, one might look to Enphase being down 25% today. There's like an overall sort of macro thing that says, you know, the overall sector hasn't got as much love as I think it deserves, especially in the wake of the Inflation Reduction Act. I think there's also an aspect that we're probably being looked at by the public markets as a speculative microcap, whereas within the industry that we're in, I think we're seen as a seasoned developer, owner, operator of projects. And I don't think that the capital markets have caught up to where we're at as a company. It's actually even less. So in Canadian dollars, low 40s, and in US, low 30s. So I think that the natural extension is that as our cash flow, you know, profile changes in a big way here in the coming quarters, you know, we're investing in growth, yes, but you know, our equity quite possibly will be the best investment that we can. So certainly that's on our mind. And yes. Yeah, and so and I think I'm getting the 1 minute mark, so it might be the last question. But in terms of yeah, so in terms of the growth, I mentioned that our portfolio is growing about 10x this year. I know a number of those projects are being turned on later in the year, so the actual recurring revenue this year might be more like 7x growth or something, but it's pretty significant in terms of how that's ramping up. And then I'll also say that, you know, it probably speaks to the last question there too about the disconnect. The recurring revenue and the EBITDA from the portfolio is, you know, ultimately what we're very excited about. But going back to like the market disconnect part, I think that like within our industry, you know, a project might be at NTP close to a year before it starts hitting the income statement, and you've generated almost all of your value at that point in time as a developer. You know what I'm saying? So I think like there's a lot of value inherently on the balance sheet even before that income statement starts ramping up. So anyway, I appreciate it. I know we have lots of meetings tomorrow, so looking forward to that. But you can definitely find us, you know, online or whatever as well. So thanks everyone.